With an increasing number of countries enacting travel restrictions to curb the outbreak, it's no surprise that the aviation industry has taken a major hit. Earlier this month, the International Air Transport Association warned that the pandemic could cost passenger airlines up to $113 billion in lost revenue this year. Back home, Changi Airport reported a 32.8% year-on-year decline in passenger movements last month due to COVID-19. Earlier this week, Singapore Airlines said it would slash its capacity by half and that it expects to make further cuts to its capacity, given the growing scale of border controls globally. It's not the only airline to do so. Singapore-based Jetstar also announced it was grounding its entire fleet of 18 Airbus 320 aircraft with all flights suspended for at least 3 weeks, from March 23rd to April 15. Other big carriers like Lufthansa, Delta and Qantas have announced significant cuts as well. Qantas is set to stop all international flights, and Europe's biggest carrier, Lufthansa, is set to cut 95% of its flights. To take this discussion further, I'm joined now by James Walton, Transportation, Hospitality and Services Sector Leader at Deloitte Southeast Asia. James, welcome to the show. Now, earlier this week, Singapore Airlines said it will operate only 50% of the capacity that had been originally scheduled up to end April. What lies ahead for SIA beyond that?
So right now, the outlook is obviously not good. We don't know exactly when the travel advisory bans will start lifting. We're seeing other markets around the world gradually introducing more and more measures to stop transport. So it's very difficult to even begin to guess when capacity will need to ramp up. As a result, SQ is offering a lot of open ticket options and encouraging people not to cancel tickets but rather to extend tickets, in part because giving refunds means cash flow. And if they can get people to extend those open tickets, it can help mean that they don't have to make as many repayments as quickly.
I see. Now, SIA said it's actively taking steps to build up its liquidity. What can the company do, and can it survive without government support?
So SQ actually posted some pretty good results in the third quarter. Back in February, they announced a 10.9% growth, although the cargo business not doing quite so well. But obviously that was really before the storm hit. Analysts believe they have relatively strong liquidity at this point in time, enough to weather the storm. By comparison, the estimates worldwide is that 75% of airlines only have enough liquidity to last 2 to 3 months, which would mean we would see airlines going out of business by May if we don't see action soon. SQ seems to be a bit stronger. When you look at the measures they're taking, they've already announced pay cuts for senior leadership in the organization. They're trying to encourage people to take voluntary leave, which obviously would mean less salary as well, and probably deferring some capex. For other airlines around the world, we're seeing them extend their lines of credit with banks, asking the government for loans. Even selling aircraft and then leasing back is one of the options as well.
Now let's dive a little bit deeper into the aviation sector, of course. Will the aviation sector see its worst economic fallout from the COVID-19 pandemic compared to past crises like 9/11, for example?
So IATA estimated about 6 weeks ago that if the COVID virus at that time stayed roughly in the markets where it was, predominantly Asia, that the impact on the industry could be losses of $63 billion of revenue. But they then said that if it extended into Europe and the Americas, we could be looking at $113 billion. Now, obviously, that has now happened. And of that 113, we're expecting around about $50 billion of those losses are in Asia. So this is a very severe impact. But what we did see after 9/11, which was predominantly America focused, obviously, and even after SARS, which was Asia focused, was it took about 6 months, 9 months, but after that, flights started to happen again. At the end of the day, people want to travel. Business people need to travel to do business. So the market will eventually pick up. It's really a question of how long it takes and how long until people feel comfortable getting on a plane again.
That's a good point. Now, let's look to the future with added precautionary measures on flights. Do you see the sector picking up when countries eventually lift their travel restrictions?
Well, definitely. I mean, the sector's been growing year on year for many years now. And as I say, if you look back to post 9/11, it took about 6 to 9 months to pick up again. I think there will be a lot of bottled up travel. So as I mentioned earlier, we're seeing SQ trying to encourage people to delay their holidays. A lot of people will want to visit their family, visit their friends, and conduct business that has been delayed. So hopefully, once the COVID pandemic is over, 6 months, 9 months, I think we'll find that the aviation sector is back to what it is. The question is whether there is enough spending power, because obviously people's incomes are down, whether there is enough staff still in the sector after redundancies and potentially people walking away from the sector, and whether there is enough capacity, because some airlines have already gone out of business and others may follow.
Now, James, just to end off the show, which sector do you think will likely collapse first? Aviation or hospitality?
I'm hoping neither. The difference between aviation and hospitality is that aviation tends to be about a handful of big players. Most countries have one national airline, a couple of low-cost carriers, which means if the government and the industry players like IATA can support those organizations, they should be able to stay afloat. The difference with hospitality, of course, is you're talking about hundreds, if not thousands, of hotels, restaurants, and ultimately, some will go out of business. It's impossible for the government to help all. It's impossible for all to stay in business in a crisis like this. So unfortunately, I think the bigger impact in the longer term will be on a lot of boutique hotels, smaller hospitality organizations that simply don't have the cash flow or the means to continue over a protracted crisis.
Well, thank you so much for your insights, James.
Thank you.
Now, that was, of course, James Walton, Transportation, Hospitality and Services Sector Leader at Deloitte Southeast Asia.